Jeremiah is asking, are lines of credit simple interest?
Okay, now you hear terms all the time being bantied about simple interest versus compound interest, blah, 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 blah. All right, so here's what's really happening. Okay, amortized interest is amortized interest. Amortized interest is the formula the banks use to figure out how much interest you pay on a loan. And the formula doesn't change. But once the formula is applied, then the banks do something different after the formula. Okay. So listen, here's what I'm talking about. When you amortize a loan, all right, like for a credit card, did you realize if the credit card companies use just the basic amortization schedule, that even on a $5,000 credit card, your minimum payment out of your payment, only like $1.25 would go to principal if we just use a basic amortization schedule. But what they do, they take the amortization schedule and then take a percentage of the debt and add it to that minimum payment. Credit card companies do that. So that's how they do it. But it's amortized interest along with adding a certain percentage of the balance, and they add it to the minimum payment. When it comes to mortgages use an amortized schedule because their balances are so much larger, then they don't add anything to it. They just use the amortization schedule to figure out what the payment will be. Now, here's what's important. Credit cards also add in daily interest. Your car loan does the same thing. So they do it based on, it's called the average daily balance. That's how they figure out your interest cost. Car loans do it, lines of credit do it, your HELOC does it. The average daily balance is how they figure out how much interest you save. On a mortgage, they don't use the average daily balance. And how do I know that? Here's how I know. Because if they did use the average daily balance, then there would be no grace period. You see, a lot of us have a grace period. You can pay your mortgage anytime between the 1st and the 15th, and your mortgage payment doesn't change. It doesn't cost you any more to pay your mortgage on the 15th than to pay it on the 1st, because that's what they chose to do. Mortgages only charge daily interest at 2 points. In the beginning, just before your first payment, because if you close this month in January, most likely your first payment isn't going to be until February or March. That does not mean they're not charging you daily interest until that time. So folks, when they say, oh, get the mortgage from us now and not make a payment for 2 months, it's not free. You are paying daily interest on that time until you start making payments. Believe that. And so when you're getting ready to pay off a mortgage, they charge daily interest at the end when you're getting ready to pay it off. So when you call and says, what's my payoff on this loan? They're saying, well, here's how much you owe. Here's what the payoff would be, because we're going to tack on some daily interest. And this payment is good until this date. They're going to give you a date that it's good till, because they're going to figure some daily interest in there. So mortgages only do it at the beginning and at the end. So when we're talking about simple interest versus compound interest, none of that really applies. What we're really talking about is, are they charging me the average daily balance and then charging interest that way? Or are they doing a straight amortized interest where they're figuring out how much interest I would pay per month and keeping it there? Now, when you're late on a mortgage, they don't charge you based on daily interest. They charge you a flat fee. They tell you what the fee is on a mortgage, because if you pay your mortgage, you have actually until the 16th, because you have, it's generally a 15-day grace period. So you actually have to the 16th to pay your mortgage with no penalty. But anytime between the 16th and the last day of the month, the fee remains the same. They don't add it up based on daily interest. Mortgages don't do that. Credit cards do. Your card loan does. You're going to pay more interest because you don't pay it on time, because they charge you daily interest. So this is going to be the real difference between all of these loans. on the rules each company applies on top of an actual amortized interest schedule. Now, amortized interest is not compound interest. Banks make amortized interest in order for them to pay compound interest. Don, how do you want to be paid on this? Do you want to be paid amortized or do you want to pay compound? Give me amortized interest all day. Give me that. I want that because I can do a lot more with the amortized interest instead of using compound interest if I'm going to make money. So this is what we're talking about, folks. So simple interest versus compound interest, those are terms that really don't apply because they don't have much meaning. We don't know what that means. So hopefully that's giving you some insight on simple interest versus compound interest. All loans are amortized. Okay?
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.